is the velocity of money? You know, the fact that you asked the question says a lot about you. And I'm really excited for you too because of it. Because, you know, every investor needs to understand it and how to apply the concept to their investing. I mean, if you'd like your $1 to work like it was $2, or maybe you'd like it to work like $3 or $4, I'm gonna break it down for you right now on exactly how to do that. You ready? Let's go. So the velocity of money is a measurement of the rate at which money is exchanged in an economy. It is the number of times that money moves from one entity to the other. It also refers to how much a unit of currency is used in a given period of time. Simply put, it's the rate at which consumers and businesses in an economy collectively spend money. This is really important stuff, but at the same time, so far, kind of boring. I get it. But stick with me because by the end of this video, you will understand how to put this economic concept to work for you inside of your investing so that you can multiply the effort your money works for you. Oh, and by the way, if you're still looking to get that first deal under your belt, I put together a free training just for you to help you get that first deal done and then earn $5,000 a month flipping contracts and properties, working as little as 1 hour a day. And you can access it at mattsfreetraining.com. All right, imagine an economy of exactly 10 leprechauns who all go by the name, you guessed it, Lucky. And each of them are completely identical in every way. And each of them is holding a giant red lollipop. Now, the lollipops are for sale for the incredibly low price of exactly $1. In addition to a lollipop, one of the 10 leprechauns is holding a dollar bill. Now, this $1 bill is the only money in the economy, so we can refer to it as the money supply. So this leprechaun, acting out of genuine zest for life and an unwavering zeal to improve his standard of living, approaches the leprechaun closest to him to buy his lollipop. Now, after exchanging the dollar for the lollipop, the first leprechaun now has 2 lollipops. The second leprechaun is ecstatic because he now has $1. However, within a few seconds, he realizes that he is without a lollipop. And so he approaches the next leprechaun asking to purchase one with his newly acquired dollar. Again, the dollar changes hands and settles in the hands of another leprechaun, who is temporarily happy until he realizes that he greatly desires a giant red lollipop again. So this scenario, it plays out again and again and again until every leprechaun has spent $1 buying a lollipop. And the dollar ends up back in the hands of the original leprechaun. Everyone has a lollipop, and there's still only $1 bill in this economy. You see, the velocity of money is a result of how fast and how many times that $1 exchanged hands. The more times and the faster the money exchanges hands, the healthier the economy. What I want you to grasp here is it was just $1 that purchased 10 $1 lollipops. That $1 performed as if it were $10. Now, you know how the velocity of money works in an economy, right? But that's not what this is all about. What I want to show you now is how you can take this velocity of money concept and put it to work in your investing, creating a healthy, happy, and abundant investment portfolio performing at a multiple of 10, just like the leprechauns and lollipops. But before I go there, if you understand the velocity of money so far, let me know by smashing the like button. And if you like the idea of multiplying the performance of your investment portfolio, make sure you click the subscribe button because I post wealth building stuff like this each and every week and you won't want to miss it. All right, now I'm going to transition from using the term velocity of money to velocity investing, as that's what I call it. So back to our leprechauns. Those were 10 different beings, right? But in this example, we're going to swap those 10 different beings out for 10 different assets. And in this example, we'll use income properties as our asset. And then you'll be the investor. So imagine you've got $100,000 to invest and you use it to buy one of these income properties. You place a tenant in the property, you collect rent from the tenant every month, and then you just do that. Nothing fancy at all. Don't do anything else. You're just a boring buy and hold real estate investor. And then after a year or so, you've collected several $1,000s in rent and the property has appreciated several $1,000s more. So you go to the bank to apply for a mortgage to buy a new income property. You use your several $1,000s as a down payment and now you own 2 income properties. You do the same thing, nothing different, place a tenant in the new property, collect rent, sit and wait. That's it. Now you've got 2 income properties producing a monthly income, and you have 2 properties appreciating. So after a year or 2, you have enough money for another down payment to purchase another income property. Again, same thing. Now you got 3 tenants that are paying you rent every month, while all 3 income properties are appreciating. Now, because you've got 3 performing properties, when it comes time to purchase the next income property, you actually have enough money now to buy 2 more, now giving you 5 total income properties, all paying you an income every month, all the while they're all appreciating in value. And if we stopped here, owning 5 income properties, how much money did we need to buy all 5? So we only needed enough money to buy the first one, right? The $100,000 that we used to buy that first property, we used that to pay for the first one, of which ultimately purchased all 5 of them for us. And you don't have to stop there. You could keep leveraging the velocity of money, your velocity investing, and the pace would pick up as time passed. But initially, the velocity started out kind of slow, didn't it? It did, because you had to wait each month to collect the rent checks, and then you had to wait for the market to appreciate. But what if we could start much faster without using 1 penny more than that original $100,000? Well, you can, and here's how. This time, instead of using just income properties as our assets, we're going to diversify. We're going to mix it up a bit. You see, we could start by depositing that $100,000 into a whole life insurance policy, where it would be very conservatively invested in the stock market at 5% or so. Nothing to write home about, I know. But as soon as we deposited our $100,000, we could immediately take a loan against it and purchase, say, Bitcoin, which over the last 10 years has averaged 150% annual return. Much better. Now our $100,000 is working for us in the stock market at 5%, and it's also working in the Bitcoin at 150%. But we know that Bitcoin is still an unproven asset, not to mention it's extremely volatile. So rather than letting it just sit there, we take out a loan against it and then go purchase an income property. So within a month or so of transactions, our $100,000 has purchased us $100,000 of stocks in our life insurance policy, $100,000 of Bitcoin, and $100,000 worth of real estate. You see, now that original $100,000 is working for us almost immediately as if it were $300,000. In the previous example, it would have taken us a few years to get to this point. The velocity of our investing is working much faster in this second example. And we could go much deeper, further, and faster, and I have. And if this is something you'd like to take a closer look at to see how you can put it to work in your portfolio in the way that I have, I encourage you to look at a free training that I put together, the compound interest scam they're not telling you about. You can find a link for that below in the description. But if you're inspired by the idea of using velocity investing to multiply the returns of your real estate investing, it might make sense for us to hop on the phone right away, sooner rather than later, to brainstorm a bit of what that might look like for you. So go ahead, head over to reiace.com, answer a few short questions about yourself and what you want to accomplish, and then pick a time that's convenient for you, for us to talk about it. All right? Thanks for watching. That's it for now. Take care. I'll see you soon.